Hi, I'm Kevin McPartland. I'm really excited to be here today with Chris Concannon, CEO of MarketAxess. We're in your amazing offices in Hudson Yards, so thanks for having me.
Great views.
Yeah, we got a great day for this. Thanks for having me.
Well, thanks for joining us. I really appreciate you coming in.
Yeah, so let's jump right in. So you've been the CEO for 6 months now. You've been here for a couple of years before that. What's it like? Is it fun being the boss? Do you get to do any real work, or is it just all meetings now?
Well, it's actually exciting. I mean, I've spent a number of years here, certainly getting my arms around not just the company, but the bond market itself. It's quite a large market, as you know. The irony is, like, 6 months on the job, we had a little bit of a banking crisis early on in the year, and so I was walking into the job post the banking crisis, and it seems like the VIX went to 13 or 14. It was sitting at 26, and things slowed down a bit. You know, when I look at what's been going on at MarketAxess since I took the job, we've been quite active. You know, we did launch a new platform, so we're rolling out a brand new platform, our next gen platform, what we're calling X Pro. And we've also launched data products associated with that. There's a number of new data products that we're rolling out that's really in combination with our new platform. We launched a new portfolio trading tool, and we recently announced acquisition of Pragma, and related to that, we announced and launched the first client algo in the credit space.
So we're going to unpack all of that, all in the midst, as you say, of a banking crisis. You know, so many have said bonds are back, right? So like just volatility in the bond market has been up, volumes continue to grow. And obviously electronification has accelerated dramatically over the last 10 years, even particularly over the last 3. But the last 18 months or so, it feels like we sort of flatlined a little bit. There hasn't been as much growth, at least in percentage terms. So how do we go to the next place? How does that start to accelerate again?
Sure. First, I think let's look at the environment, right? We did actually have volatility in the first quarter. Now we've seen much less volatility in the market. Electronification does accelerate around volatility. It's an easy tool to use in highly volatile markets. So volatility does impact the adoption of electronic trading, but more broadly, we were just in the first phase of electronification. I call it the replication phase. It's when we take what folks do on the phone and in chat and move it into an electronic form. So it's just replicating the same outcome of what they were doing on phone and chat. The next phase of electronification is where we change outcome, change behavior, and we change outcome. How you actually conduct a trade is the next phase. And I think we're just entering that phase with yields where they are and the potential growth of the fixed income market. We're at historic yields, and so investment flows should shift in the coming environment. And so with that demand for execution from large asset managers as flows come in, they're going to need to adopt highly scalable electronic solutions, and they have the opportunity to change their behaviors. And so things like the algo that we launched, which allows clients to take advantage of this active market and be passive for the first time, use limit orders. Remember, an RFQ is a auction, a private auction where you cross the spread. And we've created a dynamic where investors can actually provide limit orders and be part of making the spread.
Right. And so obviously it's not your father, mother's, grandfather's RFQ anymore, right? Like even RFQ has come a long way, but you're saying like there's still another step beyond that.
There's a huge step beyond it, and we've seen it play out in other asset classes. If you really think about what MarketAxess has delivered, it delivered the first replication phase of electronic trading. It took all of that phone and chat and put it into an electronic form, and that's an efficient process. The next innovation that MarketAxess delivered was all-to-all. So it allowed new entrants to come into the market to act as alternative market makers, alternative liquidity providers. It connected the ETF market into the underlying bond market. And so we've seen ETF market makers become large liquidity providers in this market. That's all fueled by all-to-all.
Sure. So I'll pick on you for being a legacy equities guy. Are we equitizing the bond market, or is that a complete, not the right way to look at it?
It's not the right way to look at it because it is a different market. It is a different asset class. We are going to leverage tools that work seamlessly across all markets, not just equities. We're going to use data elements that work across all markets, not just equities. But the behaviors that we see in other markets like equities from the buy side of finding efficient solutions to executing a trade, we'll see that behavior shift into the fixed income market.
Fair. So algos, TCA, all the things that are just completely ubiquitous on those.
Exactly. But there are some key differences in the fixed income market that we'll explore a little later.
Yeah. So good segue into algos. So you recently acquired Pragma Trading, right? They've been around for ages. They're really well known in equity and FX algos. Obviously, they're going into credit now that they're going to be part of MarketAxess. So can you tell us a little bit about the rationale for that acquisition?
Sure. I mean, first of all, we acquired a very talented tech team. So about 60 people in the company, largely all technologists, and I would say at the cutting end of technology in financial services. The IP that comes with that acquisition is powerful. It's got AI-driven tools, it's got all kinds of high-speed consumption of data products. So it's just a very powerful tech platform. And we're pretty excited about having both the FX and the equity algo business. It's actually a very good business that we're acquiring. But the IP that bleeds over from those businesses into how we're going to deploy algos in the fixed income market makes it that much more interesting. Certainly we could build a fixed income algo, but if you really think about the FX algos and the equity algos, they are at the leading edge of development. It's so competitive in the equity algo space, you have to be good at it. And we're going to benefit from all that IP that they've built, but also the future IP of that business. So you have to be in the equity algo space to get that IP, that cutting edge IP, and insert it into fixed income.
That's interesting. So you're going to continue to run that like equity focused business and grow that business while using that expertise to grow the fixed income side.
What's nice about the business is it's a broker neutral business. It means they provide technology to dealers to help them execute their client flow. And if you really think about what MarketAxess, we marry dealer liquidity with clients. And we're a dealer neutral platform. And we find dealers and we put them together with clients. So it marries our business quite nicely. It just has an equity element to it. But like I said, that cutting edge equity algo business is a key ingredient to have a powerful fixed income algo.
So you recently launched your own algo. You mentioned that up front. I assume that's going to get integrated with the Pragma team and sort of developing that. Can you explain a little bit about what that algo is and how it works now?
Sure. Our Adaptive Auto-X it's really part of our full automation suite. So there's a lot of different elements to automating the fixed income market. But what Adaptive does is, if you look at MarketAxess, we've launched a number of protocols. We have live markets, we have traditional RFQ, we have all-to-all RFQ. We have an automation suite. Adaptive puts it all together into a behavior that we think clients find beneficial, which allows clients to actually provide liquidity, but at the same time, the algo will smartly switch and cross the bid-offer spread, execute an RFQ. So you get done on your order, but you increase your likelihood of substantial savings by being a provider of liquidity. These are the basics that we find in the futures market and the FX market, traditional algos. And so we're allowing clients to look at the market holistically, look across multiple protocols, and actually provide limit orders, provide liquidity before crossing the spread and being a taker of liquidity.
So let's do like a practical example. I'm an asset manager. I assume it's going to send an inquiry into Open Trading, right? So like an anonymous RFQ to all. What does it do with live markets and how does it all tie together?
First of all, the data is a key ingredient. So we can actually predict what the likelihood of an incoming inquiry into MarketAxess is at the CUSIP level, at the bond level. So you'll be looking at more liquid bonds that you think you have an opportunity to be passive, not cross-spread. What the Adaptive Auto-X will do is it will take your order, say 10 million for a particular CUSIP, and it will try to be a provider of liquidity. It effectively use a limit order. It places a limit order on live markets, prices that limit order right at the market.
And live markets is like order book stuff.
Traditional order book, our live markets is a full order book across highly liquid bonds in the US corporate bond market. So it leverages that one protocol, allows you to have part of your order out there for display. It then waits in the market to see if an inquiry is coming in. If another client or another dealer asks for a price, it will automatically respond. And it will adjust that price as the market moves. So it's tracking the market like a pegged order in equities and FX, and it moves with the market. And then at some point during the day, it will say, I actually need the liquidity, so I'm going to go out and start RFQing. So it proactively starts RFQing.
So when it needs to get more aggressive, it knows, okay, we're running out of time, we have to get this done.
I have to get this done. So it gets your order done, but if you can achieve 20 to 30% of that, call it 10 million size order, without crossing the bid offer spread in the bond market, it's a sizable savings, and it changes your outcome. Again, we're designing things that change the outcome with electronification, not just change the form in which you do it.
Could you foresee a future where that algo can route out, like, again, talking equities, like route out to maybe another liquidity venue where there's potentially a better execution?
It's designed to see all markets, both internal and external, and it can go anywhere.
And that would be to me a game changer in fixed income. That doesn't exist today.
That doesn't exist today, but it's a path that is highly likely where as the market fragments, things like algos, tools that we provide, kind of bring that market back together in an aggregated form.
And so you said data is super important. There's so much more of it today. Is there AI, true AI involved in some of that? Obviously, we know that you and some of your peers in evaluated bond pricing, there's been AI involved there for a while. But is there AI involved in this execution process?
Let's just say there's AI all over this office. We are producing lots of AI products. CP Plus is the gold standard of our data products. It's obviously become a benchmark for real-time pricing in the corporate bond market. The algo uses CP Plus, so it's taking AI-derived pricing and it's using that to price orders. It's using that to, whether it's providing liquidity or it's looking at inbound RFQs or it's going out and RFQing to the market. It's always looking at that real-time price. But things like tradability, which determines how many responses you'll get to a given RFQ, that's an AI-derived data product that we use here at MarketAxess, and that allows you to see the depth of the market. So the algo will determine what size can it really engage the market in, what sizes can it actually consume from the market at any given time. And that dynamically changes. And so if you think about it, a trader typically thinks about a bond in a very kind of binary way. It's either liquid, not liquid, kind of knows how to trade that bond. That changes all day long. Volatility strikes, the liquidity may dissipate. If it's less volatile, there might be more liquidity. These data products are real time and provide that level of activity in the market on a regular basis, with AI kind of looking at the market and reinforcing the market behavior.
That's what's so cool. Like, it's truly learning. Like, the more it does things, the better it can do it the next time. Right?
Exactly.
Which is amazing.
Yeah. If you think about it, the bond market is not the most transparent market. The best pre-trade analytics that people are using is an indicative price from a dealer called an AX. Now, most dealers will trade on that X, but that's still I think I'm willing to trade at this price.
But we still can, there's still time to negotiate.
There's always time to negotiate. And so all of these products, if you really think about it, we're 20% of the corporate bond market. But we see a much larger share of the bond market because we include in our data those inquiries that fail. So you go out and request price, prices come back and you choose not to trade on those prices. Those prices still feed our data products. So we're larger than the actual share in which we engage the market. Our data is consuming all that, aggregating it and forming price or forming depth. So we're doing a lot in that data space.
That's a unique feature of trading venues and bonds, right? Is being able to see the cover or the next four that didn't win and really being able to put that data to work and no one other than the venues has that level of view into what's happening and how trading works.
The bond market is a series of private auctions. Every client requests a price, that's a private auction to that client. Those prices are unique to that client many times. So some of our data feeds will tell you, depending on the client and the size of your request, what the prices back would look like. So CP plus responder is that concept. So we have a number of these data feeds that will give you, down to the type of client, what price you should expect back.
It's amazing. So ETFs are another growing part of corporate bond trading in general. Obviously, the retail surge in interest has certainly helped, but it was there before. So what's your play there, right? Because obviously a lot of your big liquidity providers and clients either are issuers or heavy traders in ETFs, and so the tail wags the dog sometimes. So what are you thinking around ETFs and sort of how that works into the ecosystem?
First of all, I credit the ETF market, the fixed income ETF market, for the initial accelerant of electronic trading in the bond market. You really had ETF market makers trying to engage a market that needed to solve an electronic execution because that ETF is fully electronic. So you always want to arbitrage in electronic form, and we've seen those ETF market makers grow in size in the market, the fixed income market. We've also seen very large banks shift their focus from traditional single bond dealer engagement to full ETF market making. And that's been very successful with some of the large dealers where they're now trading ETFs and bonds in the same P&L. And we've seen the rise of the portfolio trading, which is really a reflection of every PT is an ETF. It's priced off an ETF, it's priced off a basket relative to an ETF. So the ETF market has been kind of a critical element to the electronification of the bond market. The good news is we see that growing. We see more ETFs, we see more passive investing in the fixed income market, whether it's an ETF or index-based management at the fund complex. We also see SMA accounts coming out with more index-based investing. That's all good for the market. There's one element that I think a lot of people miss around passive investing in fixed income, because they think about ETFs. But there's something that I call concentration. There's only so many indexes that are going to survive in this passive investment flow that comes into the market. It tends to concentrate the market around the most liquid end of those indices. And so you get higher levels of activity through concentration. People want to benchmark to that index, people want to trade the index, people want to do a portfolio trade against the index. That's all concentration around those indices, and we're seeing elements of that today.
So the JNK, HYG, whatever's in those, that's where the bonds trade as well.
That's where you see that. I mean, if you go through their list of bonds, you see the higher activity levels in the bond market. And then remember, every bond has a correlation bond associated with it. Maybe the ETF fund manager will accept that bond as an alternative in a creation redemption exchange. So every ETF is then multiplied by those alternatives that they will accept in and out of creation redemption. But it all impacts concentration, which impacts turnover. And liquidity available in the market is critical. And it also allows, so if you're a client and you always think about crossing the spread and launching an RFQ to get liquidity, you now can be a provider of liquidity because there's enough interest in that concentrated bond that you can actually be a liquidity provider and not cross spread.
And this all sounds like another link back to Pragma and equity algos, right? To try, you could see, right, trade the ETFs and the bonds side by side.
Exactly. It's all, again, traders can't do where we're headed, right? It's going to be a highly complicated real-time data, AI data feeding these trade decisions. No human can consume that and react. And trading bots or algos, they can consume all that data and respond quickly.
So thinking about the competitive landscape overall, you can see in the volume data, it looks like sort of TradeWeb has been gaining ground, right? They've had some interesting new products. So how do you think about that? Sort of how do you look to stay ahead and grow and maybe pick up some of that ground back?
Well, I definitely, there's this famous Jeff Bezos quote that I love, which is obsess about your customers, not your competition. And it's true. When I look at what we're building and what we're doing, we're changing client behavior. We're changing how clients engage the market. And to me, that's powerful. And it's where the majority of the market is. Like that, call it 60% of the market that is still on chat or phone. Like that's the market we're focused on and obsessing about. And it's really making it clients change their behavior to improve their outcome. And so that's literally that's what we focus on, and that's all we spend our time on. And when I look at the electronification and the accelerants that are, and the potential for accelerants, it's all about that client engagement, about adopting all these new products that we're using. Portfolio trading is an electronic trade,
sure.
And that's still accelerating. I think we're still in early days of developing how to do a portfolio trade. Remember, the early portfolio trades were, hey, I think I put together a basket that can trade as one price. Now, with our data, things like tradability and the depth of that market, we can help you optimize that portfolio. So now we're into portfolio optimization. What's the best mix of this basket to actually get a better price? By the way, if you correlate it to an ETF, you get a better price. So correlation of your portfolio is a key ingredient to getting best price when trading a portfolio.
So it makes me think like there's two areas of opportunity. There's the 60 some odd percent that's voice, and then the 40% can be still more efficient, more automated, more algo driven, right? Less point and click. So there's opportunities really on both sides.
The way I think about it is the 40 that's already come over to the electronic side, that's not automated. There's still a trader. And so that 40 can go to full automation, and the other 60 still has to be attacked.
Right, so a lot of opportunity there.
And look, the key here is where do all these dealers sit in their view of electronification? And when we talk to the large investment banks, they're looking at the market saying, I create price in all these bonds. If it goes electronic, I still create the same price. And so they see the benefits of that conversion as well, because they've made the necessary investment to be able to produce prices electronically. And now if the sales channel brings it in over the phone or electronically, they're still making that price and making spread.
Sure. And then maybe 20 years ago, the same banks that would have been nervous are the ones that are the most innovative, right, about moving into E and doing more automated and streams and portfolios and everything else. So really it has changed, the mentality's changed.
I would say the competitive dynamic that's unfolding among the large dealers is accelerating the electronification. They are now seeing some dealers race ahead with the sizable investments into what they are predicting will be the future of this market. And so it's a competitive dynamic to race there. If you look at portfolio trading, there's sizable investments by large investment banks to put ETF trading together with their desks because they want to be on the cutting edge of portfolio trading. That is a fully electronic price making business.
It has to be to do it efficiently, to use your balance sheet efficiently, it has to be.
Exactly. So that dealer adjustment that we see and the dealer behavior that we see encourages me about the 60, and it's coming. It's coming over to the electronic side.
So other growth areas, actually two areas you guys are focused on, but polar opposite markets, treasuries and munis. Both have problems and room for improvement, but completely opposite. Why don't we start with munis, right? We keep trying to track e-trading there. It really isn't budging. Maybe it's 10 to 15% depending on the month.
Yeah.
So what's been the progress there? Do you feel like we're maybe starting to get some traction in that market could start to change?
I do, and if you think about the muni market, price is probably the most difficult element of the muni market because of the diversification of product, right? There's lots of different states There's lots of different municipals within those states, so the product diversification is huge.
1 million CUSIPs.
Over 1 million CUSIPs, and not all that active, right? Many of them are buy and hold CUSIPs, but if you look at the other metrics of that market, which are small tickets, there aren't large blocks in the muni market. The manual engagement of the muni market. When we go to our buy-side clients, their muni desk is bigger than their investment grade desk, just because of the number of tickets and the manual interactions and the brokerage market that's there. I see that market as when it goes all the way. Meaning like when you start adopting super efficient, automated means of collecting price in the muni market, people will adopt those quicker and faster because of the efficiencies that it delivers.
Well, and it's so retail by definition that you would think retail markets would be small size, electronic, and efficient, right?
The average size in the muni market is retail. And we do see retail growing in the muni market, so you see that activity level picking up. We also see large SMA growth. The retail muni market is really coming in through the SMA market, which goes to the institutional desk. And they need that to be super efficient. In the past, when munis picked up, it was really direct muni investing by clients through their FA into the more traditional electronic venues. We're seeing SMA pick up directly, and that's institutional driven.
Yeah, well, and I guess the SMAs are growing because the bonds are attractive, but also now because the technology is making it easier to rebalance those portfolios, which should then make it more electronic, and on we go.
Exactly. So you have the yield sitting there attracting assets. What's the best product that you can go to? You can go to an ETF, a direct FA, or you can go to an SMA and get institutional level pricing at the retail level. That's the true attraction of SMA, and you can get indexed into that SMA. There's all different types of product that you can enjoy, but when that SMA account comes through a large institutional investor, they need to automate that. And we launched just in the beginning of the year our full RFQ automation in the muni market, and it's been growing and embraced dramatically.
That's great. Yeah, I've been sort of looking forward to that market automating for years, so I think hopefully we're finally getting there.
Well, we've achieved 5.8% market share in that market, and I still see it as early days. We are developing data around that market as well. As we grow our market share, our data gets better. So we're confident that we'll have data products throughout the muni market as well.
Great. So the polar opposite, U.S. Treasuries, at least 2/3 electronic today, hyper competitive from a venue perspective. So you're effectively the new entrant there.
Right.
So what's going to be a catalyst to start having more volume come onto MarketAxess there? So
the Treasury market is a conundrum. It's one of the more liquid markets on the planet. It's unlike the muni market. It has less CUSIPs. And those are more concentrated and highly liquid. So when you think about on the run, it's also a streaming price market. People are streaming prices in a variety of different protocols in a variety of different markets. So when you think about the all-to-all inter-dealer markets, the electronic markets, it's really a dealer-to-dealer platform where brokers and dealers come to interact, find price super fast, constantly engaging the futures market as well for that basis trade. The institutional market is still RFQ. So you have this one market that's high speed, microsecond streaming price, and the bifurcated institutional market, which is still requesting price, massive size, but still requesting price on an RFQ private basis. And we see that world converging. We see streaming price and the ability to engage that streaming price at the client level coming together for the first time in a long time. It's how other markets work, right? The futures market is order book with clients engaging directly. The futures market, FX, we now have clients, large institutional clients, using algos to engage both the ECNs and the RFQ market. And so we see the fixed income, the treasury market developing in a very similar way to the FX market. There's lots of corollaries that are playing out in the treasury market. So we certainly we have a full order book and we have a full RFQ platform for treasuries, and we're the disruptor. So it's kind of nice being the disruptor in that space. And so it's really delivering a client behavior that's now unique in the treasury market. If you think about the balance sheet challenges that we see in the treasury market, whenever there's volatility, those balance sheets constrict, yet the client demand goes up for liquidity. And so they're inversely related, and having a tool where the client doesn't have to tap into balance sheet, but actually can be a liquidity provider is a unique ingredient that the treasury market and the institutional clients haven't seen. And that's really where we're deploying our treasury tools today. And we're just about to obviously enhance those tools and bring more automation and more features to the treasury market.
Yeah.
So we're pretty excited.
Yeah, no, and you can see like the top line electronic trading doesn't show how much is changing under the surface. We can see like the traditional anonymous legacy order book markets are shrinking, right? Whereas like sort of everything else in the middle, which is some spectrum of RFQ to streaming, has really been growing. And I think you can kind of also see it in the data that the clients are driving the market in a lot of ways more than the dealers are, which is just an amazing transformation over the last 10 years.
I do think there's massive internalization happening because if you're a very large dealer, there's a lot of internalization that you can do in that market, and that's not shown. That's fully electronic and fully automated, but that's a component of the market that we're not seeing, but we know is a key component. But it's, again, changing client behavior and introducing tools and data that allows clients to be comfortable changing that behavior.
Yeah, and we shouldn't go down the regulatory rabbit hole today, but it's been interesting to how these markets have gotten to where they are with almost no regulatory sort of dictate or mandate as to this is what you have to do. It's just grown organically, which I think is why the market continues to work.
You know, I obviously grew up in equities where regulators inserted themselves into the market structure, and there's good and bad outcomes. It accelerated electronic trading, but now we have complicated, fragmented markets. I think what's happening in the fixed income markets is it's developing. The electronification is happening commercially. It's solving demands by clients to better outcomes. And so when I think about regulatory accelerants, obviously balance sheet requirements for banks impacted the market and could impact the future of the treasury market. But most of the things that are happening are based on client demand and client needs. And if you look at the clients, right, these are large institutional investors with lots of competition and compression of expenses. And so they need to find new and more efficient ways to execute their trades. And they're not hiring traders. And so they're looking to others to build product that solves and delivers unique outcomes for them.
Yeah. Everybody is angling for more efficiency, right? The banks, the buy side, and everybody in between, right? How can we effectively do more with less, for sure?
That is the moral of 2023. Think about it, right? 2022, all of the losses incurred by investors in large mutual funds, large complexes, that cut the budgets, the tech budgets, the hiring budgets of 2023. We're still living under that dynamic, and so our clients aren't hiring traders. They're not making large investments in trading technology. Where they are investing is collecting AUM. That's where they want to focus their investment, and we're making huge investments in trading technology.
Chris, thanks for being so open. It's a great, fascinating conversation. Congrats on the success so far, and I'm sure there'll be lots of cool stuff to come.
Yeah, a lot to come, and I appreciate you coming in and chatting with me.
Yeah, thanks for having me.